There is a common idea that it's only those that spend on crazy lifestyles that end up with unmanageable debt. But more often than not, it's a slow start to a process that can have you sinking in crushing debt. I am pretty sure you have a good understanding how much money you make and how much you spend on housing and utilities and all your other expenses. You may even have a good budget, and yet somehow you are still often a few $100s short at the end of every month. And as money goes, this can be a huge problem. Credit card charges pile up little by little because you spend a little more every month than you make. This is the definition of being in quicksand. Little moves slowly push you deeper until you can't move and you are stuck. And your first instinct is that you probably need a better budget. On the surface, that sounds like a good idea. Track where your spending goes, keep all the receipts, don't buy that extra morning coffee. But all this really does is suck up your time and actually creates more stress. Your life already requires plenty of time and your attention every day. Your budgets should be a working guide, not fixed manuscripts that have no wiggle room. Unexpected expenses are always going to come up because life isn't a fixed script and there are plenty of plot twists that always sneak up. You can't predict what the unpredictable spending will be in the future. So detailed budgets are good for short-term goals like a planned vacation, a house reno, new gear. In these cases, your spending will actually come in more or less on budget in a predictable way. But life is anything but predictable. One way that I get around this is by having money buckets, or thinking bigger, money pools. More specifically, it's actually accounts that have very specific purposes. This is a snapshot of how you can set up your money pools. You have your income. It's usually a checking account where all your earned income goes first, from your job, your freelance, from your side hustles, and any other income streams. This is where the money then flows to your other money pools. And typically, people start by funneling that money into their expenses. Housing, utilities like heating and water, internet, phone, also many monthly services that you're using, car, food, property taxes, personal taxes if you're self-employed, insurance, and a big chunk of it into debt payments. Another separate pool is long-term saving. This is mainly investment accounts for retirement or tax-free savings accounts, down payments, kids' education, anything where the money will be used in the future sometime. Next is an emergency fund, or I like to call an employment fund. This is for the mother of all unpredictable expenses. It's typically a capped account with 3 to 6 months of money to cover all your expenses. But to start, it can be as little as $2,000 at all times for small emergencies and repairs, with the goal to grow it over time to 3 to 6 months. Now, 3 to 6 months is the minimum for this account. You can let it grow to 9 to 12 months. It may take you 5 years to grow it, but being ready for any other downturn when it happens is the ultimate goal. The next money pool is short-term savings. This is what I call the fun account for vacations, home upgrades, that new car, clothing, nights out, whatever you want. It's for fun. This is where the remainder of your money should fall. Because all the work that you do and spend time on, you should have something fun to look forward to without just slapping it on a credit card and hoping to pay it off with some future income. But never fool yourself into thinking that money will always flow at a constant rate over the years. And as many of us have found out over the last few years, that it is variable. When setting up these accounts, look for the best types of accounts with the lowest monthly fee. Most banks do have options to tie multiple accounts to your main checking account with almost no fee, as long as you do most of your banking online and do minimal monthly transfers to those accounts. If you're depositing once a month, you should be able to set up this account for free or next to nothing. When looking into them, take your time to do the research with your own bank. A typical month may look like this. Money flows into your checking account, your earned income. This is where you pay yourself first. Put money into your long-term accounts, and if you're just starting out, make it $100 if you can swing it. But even $10 a month is still paying yourself first. Get in that pattern to create the habit. You can also make this automatic through online banking, treating it like an expense that just has to get paid. Then put money into your short-term account and your emergency fund. Again, you will know the amount to put in based on your current situation. Then focus on your monthly expenses and make sure that your debt payments are always way more than the minimum. After all that, whatever is left over, you have a choice here. Put it towards debt or put more into your short-term savings. I tend to put everything left over into debt because there aren't very many investments or savings accounts that can match the 20% interest to offset how much credit cards can eat up. So it all depends on how aggressive you want to be to pay down debt, or to save more. Once you have settled into a routine of adding to your money pools and you are managing your debt, that's when you can start to look into setting up an opportunity fund. This is another separate account that you can use when you want to buy investments when the right time comes up. Because if you are money set when a downturn happens, you can buy stocks or other assets at huge discounts. But first, you do need to get your finances in order and know where your money is going and how much money you need to be making daily to achieve your financial goals. In this video, I walk through how to organize your finances as a freelancer and set a proper day rate for you. See you over there.